MDA presents Decoding Debt Instrument Valuation.
Dr. Mauricio de Anda Hernández.
Ever wondered how the world of finance operates, especially when it comes to debt instruments? Well, it's quite an intriguing story. A debt instrument, in its simplest form, is a contract or an agreement between two parties where one lends money to the other. The borrower promises to repay the money with an added interest over a specified period of time. These instruments could range from loans and bonds to promissory notes. They are an integral part of the financial market, forming the backbone of many investment portfolios. But how does one determine the value of these debt instruments? It's easy to assume it's just the face value of the loan or bond, but in reality, it's a bit more complex. The valuation of a debt instrument considers numerous factors. Firstly, the interest rate plays a vital role. It's the cost of borrowing or the return on investment, depending on which side of the transaction you're on. A higher interest rate makes a debt instrument more valuable to the investor, as it means higher returns. Secondly, the time until maturity is considered. The longer the maturity, the more uncertainty, thus, the higher the risk. This risk might devalue the instrument. Finally, the creditworthiness of the issuer comes into play. A borrower with a high credit rating is deemed less risky, and therefore their debt instrument would be viewed as more valuable. Combining all these factors, the valuation process uses a technique known as discounting. This involves calculating the present value of all future cash flows, both interest payments and the repayment of the principal, that the debt instrument will generate. To sum it up, a debt instrument is a financial agreement that facilitates borrowing and lending of money. The value of these instruments is not merely the face value, but a more complex calculation involving the interest rate, time until maturity, and the creditworthiness of the issuer. Remember, the world of finance is not always as straightforward as it seems. It's a maze of numbers, calculations, and risks. But with a keen eye and a clear understanding, it's possible to navigate through it all. After all, understanding is the first step to mastery. So the next time you come across a debt instrument, remember, it's not just a piece of paper. It's a story of money, risk, and returns. And now, you know how to read that story.